And in other news, the Monetary Policy Committee of the Central Bank of Nigeria concluded its two-day meeting on Tuesday to review recent economic and financial developments as well as assess risk to the outlook. MPC at the end of the meeting elected to hike the MPR by 200 basis points. The new interest rate is a jump from the 22.75% announced by the MPC about a month ago, and the second rate hike by the current committee. Cardoso, as the CBN governor, announced the retention of the cash reserve ratio of deposit money banks at 45%. However, the MPC also adjusted the CRR of merchant banks from 10 to 14%. The committee also retained the liquidity ratio at 30%. And Managing Director of Cowry Asset Management Limited, John Chukwu, joins us now to discuss the outcome of the MPC meeting and its impact on the economy. He will also discuss the sudden appreciation of the Naira and President Tinubu's new infrastructure funds. It's good to have you with us as always.
Thank you for having me. Good afternoon.
Good afternoon. All right, so what major cues did you observe on the outcome of the recent MPC meeting, and has anything changed over time for the CBN, you think?
Well, there's a single word I would say used to describe what I observed is the MPC is quite aggressive. I think the word is aggressiveness in terms of monetary tightening. If you recall, they increased by 400 basis points in February from 18.75 to 22.75. And then that was barely a month when the second MPC meeting for this year held. And recall that previously MPC meetings were holding every 2 months. The 2 months time line was to allow for the effectiveness or for the full impact of policy decisions to permeate the economy and therefore help them shape the next action they need to take. Given that the increment that we saw was in February, which was just a month before the second increment of another 200 basis points. So that's why I use the word aggressive, because there was no time. There was no time for the policies that were taken in February to fully go through the system and reflect in all facets of the economy. We've seen the impact on exchange rate. We have not seen the impact on inflation. We've not seen the impact on productivity. Those are three components that the monetary policy must always take into consideration in taking their decisions.
Very well said. Now, how might these decisions affect lending and borrowing rates, whether it's for individuals or businesses in Nigeria? Could it impact investment and consumer spending patterns?
Well, I think that in the first place, when the Monetary Committee tightened, the intention is to slow down on credit. But unfortunately, we have the uniqueness of our economy. There's actually no consumer credit. Nigerians consume based on their income, not based on borrowing from banks. But the impact will reflect more on productive activities because it's producers and need to borrow. You and I would not, there's no consumer credit. If you go to your bank and say, I want to borrow money and buy a television or buy a shirt, nobody give you that. Nobody even have a credit card in Nigeria, Naira credit card to allow you to borrow from your bank. So tightening the liquidity rate in the banking system by increasing policy rate does not affect consumption. Nigerians are already in difficulties based on the fact they don't earn enough income to consume. So what you look at is that what's the impact on this on the productive sector, particularly the manufacturers. For the traders, the assets commercial cycle is very short. Maybe they buy today and sell in 30 days. But for the manufacturers, the asset commercial cycle is always minimum 90 days. So they're the ones that have to bear interest costs for 90 days or more. And they're the ones that will find it difficult to factor in or absorb this higher interest rate on their cost of production. So even if they do that, they're going to see that the final products produced by manufacturers based on the current interest rate, which will take some time to manifest, will be much higher than what it was before. So, and how they push that into the market at a time when there is no consumer demand, when consumers are suffering from lack of purchasing power, it's going to be a challenge. So ultimately we'll see a slowdown in productive activities. You're going to see a slowdown in GDP growth rate. And while on the positive side, you may see a slowdown in inflation rate and a slowdown in exchange rate depreciation.
All right, so talking about exchange rates now, the appreciation of the Naira recently to 1,350 Naira to a dollar. And what do you think is driving this scenario, and how sustainable you think? Not too long ago, I think the CBN was read a little bit of riot act by the president when it was, trading a little bit above 2,000 Naira or thereabouts. So between that time and now, we're seeing a steady, appreciation of the Naira?
I think the major factor driving the Naira appreciation is lack of liquidity, Naira liquidity. With the increase in rates, we've seen CBN come to the market and issue treasury bills at more than 21%. We've seen bonds issued at more than 21%. And the last count, I think Central Bank has taken out, sucked that up more than 10 trillion Naira from the economy. So there is no Naira liquidity. And that is constraining real sector productive activities. So even the average business person does not have Naira to go and demand for FS to go and replenish their stock. So some of these things are going to reflect further as we go by, as time passes by, because you are not seeing the fact, and that's why they talk of lag effect on in economic policy decisions. When you take a policy of this nature, there are those that will have immediate impact. The immediate impact is that I go to my bank, I want to borrow money, and the bank tells me the minimum we can lend to you is at 27%, and I do my figures. I say at 27% I will not be able to produce and sell, so I pull back, so I don't produce. And if that happens for the next 2 months, I will ask my staff, I can't continue to pay you salary, so you have to leave the employment. When the guy leaves employment, he can no longer buy the goods he used to buy. So the demand will further slow down. And you're going to see a multiplier effect of that. But that will take some time to manifest. So, but what you are seeing in the immediate is that business people do not have the liquidity to replenish their stock, to buy FX. And that's what we are seeing. So in terms of demand-supply metrics, we're seeing a sharp drop in demand. And automatically, if you see a sharp drop in demand, even if there's no improvement in supply, prices will go down. And that's what we're seeing. The price of FX has gone down because demand has actually collapsed.
Indeed. Now, what's your assessment of MPC's approach when it comes to balancing the need for economic growth with the objective of maintaining price stability and curbing inflation?
I think I would say with all sense of respect to the members of MPC that their side is turned towards fighting inflation. You can have two approaches to how you view things. A tunnel approach or a bed approach. A tunnel approach simply you want to focus on one item and you do everything to fight it. But you know that dealing with the economy is a very delicate balancing act. So you have to look at, if I deal with this, what is the impact on this? Clearly, they are fighting aggressively the issue of exchange rate. That will further ultimately have some impact, salutary impact on inflation over time. But remember, inflation is measured year on year. So before you begin to see this, it may be in the next 2 months, the impact of that policy. But the core problem with inflation has to do with the food production. If we don't improve food production, the impact of inflation will only be related to import-induced portion of the inflationary pressures. The food inflation, which came at a print about 37.92% in February, will still have to contend with it by improving food production. So, but then, like I said earlier, there are also other impacts of these policies that will take a longer time to manifest. So, but if the Monetary Policy Committee can say my priority is price stability. So we're looking at exchange rate, interest rate, and consumer price index, which is inflation. So if we do that, we have succeeded in our core mandate. But the larger economy has to deal with the issue of productivity, which is also related to the issue of employment. Employment is also related to the issue of social stability, social stability in the social environment. Because if people lose their jobs, it could lead to an uptick in social harmony, disharmony, sorry. Social disharmony if a lot of people lose their jobs. So for the government, they need to make sure that we balance all these things.
Balancing is key, but when it comes to tinkering with thoughts like the NPR raises to 24.7%, as it were, how realistic is it, in real terms? It's one thing to tinker with all these figures, but how realistic is, when it comes to, impacting the lives of people, as it were? Because the issue here about Nigerian inflation is that you don't hear incidents of it ever reduce it. It's all about being raised, and you have that steady increase, as it were, over time.
Let me even start from that point, because there's always a misconception about inflation reducing and disinflation. You have disinflation and deflation. This inflation is that inflation is increasing at a lower rate. Like we have seen an increase from 29.9% to 31.7%. So you are seeing that increase. You can also see in the next maybe 4 months or 5 months, you see inflation rate increase at 25%. So that's disinflation. So inflation is increasing, but increasing at a lower rate. But remember, we have to bear this in mind. You are measuring one period last year to this period this year. The price levels are not reducing, but they are still increasing, but increasing at a lower tempo.
Okay.
And that's when people be imagine, okay, I went to the market in January last year. I bought this product for 200 Naira. I went to the market in March. Maybe March this year, maybe March last year, I bought at 200 Naira. I went to the market March this year, I bought it at 220 Naira. And you are telling me inflation is slowing down, inflation is reducing. But I'm seeing an increase of 10% on the price I bought it the previous year. But the guy who is measuring inflation is saying, look, the previous year, when you compare February last year and February this year, the prices at February, maybe we are maybe 150. They increased to 200. So that was a 30% increase. Okay? Or 25% increase. Yeah, 30% increase from 150 to 200. It was a 30% increase. So, but now, it has increased from 200 to 220. It's 10% increase. The guy saying inflation is slowing down. The guy who is in the market saying, look, I don't understand what they're talking about.
I don't know if I may just comment, you go to shops these days, and besides, you go in, you want to purchase an item, before you know it, that item has changed within 24 hours. That's the scenario right now. So if you can just give us your thoughts on that.
Well, that was, I think that we moderate to some extent, because what was happening is that exchange rate was moving on per second basis. And business people needed to price their products at replacement cost.
Okay.
So at that point, they came to the market today and opened their shop and said, look, I bought this item for $1. So it simply means this to me was 1,500 Naira. In the afternoon, somebody comes to him and says, look, what dollar is 1,600 though? He said, if I have to buy this, replace this stock, I have to buy dollar 1,600. He changed his price from 1,500 he started in the morning to 1,600. Then later, maybe late afternoon, somebody comes and says, it's now 1,700. He said, look, I'm not selling for 1,600 again because my replacement cost is now 1,700. So I think that will reverse in the near future, in the immediate, because we are seeing a moderation in exchange rate. So what people are even doing now, they're holding back on their purchases of items that have foreign currency component, hoping that Naira will further strengthen, and that those who imported those products will have to absorb losses because they have to sell at the replacement cost. Because if they don't sell, those who are bringing new products will land at a lower cost, and they will be forced to compete with those who have landed at near new products at lower cost.
So how do you evaluate MPC's communication and transparency when it comes to explaining their decisions and rationale, whether it's to the public and various stakeholders? Do you think they did a fair job?
Yes, I think they clearly spoke on the issue they took into consideration in arriving at their decisions. Like I said, those issues they took into consideration are the facts of the matter. But whether they looked at all of them weighed equally in their decision points or in their decision metrics is a different thing. I did say that they were obviously tunneled on fighting inflation. But they also talked about, fighting the exchange rate depreciation and therefore fighting inflation. But they also made reference to the issue of productivity. And but whether the issue of productivity, which if you look at their core mandate, is not part of it, but for the Federal Reserve Bank of US, it's part of their mandate to ensure increase in productive activities and full employment. So if that's also part of their core mandate, then their decisions may have been different, because they would have said, okay, yes, we're going to fight to moderate the exchange rate, keep inflation low, but the impact will be, the unintended consequence will be, you're going to see drastic drop in productive activities, loss of jobs. And if our mandate is also to ensure increase in productive activities and full employment, we will not be able to fulfill that. But the any economic decision maker will always say, what is of priority to be at this point?
Yeah.
And every government must also bear in mind what is their priority. It's a delicate balancing act. So you can't really manage all of them equally at the same time.
All right.
But you have to ask yourself, what is of priority to you? And the focus will be on your priorities.
Okay, briefly on priorities as well. Let's talk about President Tinubu's new infrastructure fund. Do you think this is a burden on public sector debt at this rate?
No, if you talk of a fund is an equity investment. If it's a bond, then it will be a borrowing that would be on the balance sheet of the federal government.
Okay.
But if it's a fund, it simply means investors will take units of the fund, own units of the fund, and they get dividend based on the performance of the fund. So such fund will be invested in infrastructure. Where the problem will come from is that government is not known in Nigeria, in this part of the world, as being the most efficient user of economic resources or deployer of economic resources. In terms of value for money, I will not give my eye, Justin Chukwu will not give my money to government to manage, hoping that they will get the best value for money. So, and I think a lot of investors are going to hold back. And unless if it is a fund that is managed by 100% by private sector, so that investment decisions are based on empirical and justifiable returns, and not based on social needs, which is what the government's investment should focus on.
Yeah. All right.
Wonderful. Managing Director, Cowry Asset Management Limited, Mr. Johnson Chukwu. Thank you so much for gracing us with your presence here on Newsday. We appreciate your time. Thank you.
The pleasure is mine.
Thank you.